Hi, I'm Ravi Venkatraman, co-founder of the Investment Solutions Institute and host of the Solutions Scoop podcast. The Institute is an independent forum dedicated to advancing the future of the investment solutions and OCIO industry. Here at the Scoop, we examine the latest solutions, marketplace developments, and speak directly with solutions industry leaders. Our guests span the investment ecosystem, from OCIOs to asset owners, investment consultants, asset managers, and other key industry stakeholders. These conversations are an important part of the Institute's mission to improve transparency and help establish standards and best practices across the solutions industry by educating asset owners, providers, and all other industry stakeholders. Let's get to today's scoop. Hi, and welcome to the Solutions Scoop. Today, I'm really excited to have Alison Davis as our guest. Hi, Alison.
Hi, Ravi. Thanks so much for having me.
Absolutely. Alison Davis is a managing director in Makena Capital's Client Strategy Group. She joined the firm at the beginning of 2016. She works closely with both domestic and international clients across different segments, including family offices, endowments and foundations, and sovereign wealth funds on their multi-asset investment portfolio. Alison also helps lead Makena's efforts with wealth channels, partnering with their advisors and clients to integrate private investment strategies into their portfolios. Prior to joining Makena, Alison worked at NEPC in Boston as an investment analyst in their E&F practice. She has a BA in political economy from Williams College and attended the London School of Economics and now lives in the Bay Area with her husband and two young children. Welcome again, Alison.
Thanks, Ravi. Happy to be here. Appreciate it.
Great. Alison, tell us a little bit about your background. You grew up in my neighborhood in Boston and then made your way to the West Coast. So tell us about your journey.
Yes, I'm very happy to be here. Thanks again, Ravi. So yes, I've been out on the West Coast in Silicon Valley for about 10 and a half years now, all at Makena. So the majority of my career has really been spent out here with that firm. Before joining Makena, though, I, as you mentioned, was an investment analyst at NEPC for a few years. That was my first full-time job out of college. I had reached NEPC really through the Williams alumni network. I had thought I was going to go down what is kind of the traditional investment banking path, maybe of yesteryear at this point, but I had been on that track throughout college, but then decided I wanted to do something different within the investment universe and try to get in front of clients sooner rather than later. And so I reached out to Eric Knudsen, who, has been a major player in the industry for a while now. He was the CIO at NEPC at the time, right as I was graduating, and was able to start my career there and kind of get the lay of the land in terms of building institutional style portfolios, particularly for endowments and foundations, which was a great lead into my time at Makena. As endowments and foundations form a core of our client base here, along with family offices.
That's great. Now, speaking of Makena, this firm is a little bit different from some of the firms we've had on the show before, which tend to be large, diversified financial services firms. Tell us a little bit about Makena and how it came to be and how the business may have evolved.
Definitely. Makena, it's a special type of investment firm, definitely unique, as you mentioned. It's actually been around for 20 years now. So at the beginning of this year, the firm crossed its 20-year anniversary of spinning out of Stanford's endowment. So at the end of 2005, the team that was managing Stanford's endowment spun out to employ the same endowment style investing approach for outside capital. So other institutions and large families who had seen the success that the team had had at Stanford, either through just living out here in Silicon Valley or being alums of the university or other affiliations with the school, they wanted to get in on what the team was doing. And so when the team spun out to form Makena, they had incredible support from day one in terms of building out the business to offer that endowment style portfolio to outside capital. So the firm started with $7 billion in cash. They had to build out a global multi-asset class investment portfolio from scratch. So that definitely differed from their experience at Stanford. But we've grown a lot from there. We're at 23 billion under management today. We do still have our flagship endowment portfolio, as we call it. Try to keep it simple for our partners, but we also offer components of the endowment as standalone vehicles for partners as well. So that includes our venture capital fund, our buyout fund, and also a active public equities portfolio. So we've evolved to work in different ways with a lot of our partners. We still serve as that kind of outsourced CIO for several, larger endowments and foundations, but we also partner with those institutions and others, particularly families, in different ways now, given the variety of our vehicles.
Great. So if I understand you correctly, you can be the full portfolio outsourced CIO,
Yes.
but you're also offering these, can I call them sleeve capabilities? And do you call
Yes.
them products or, yeah?
They are products. They're
Yeah.
they're standalone funds that we offer, but they are the same portfolios, asset class portfolios as in the endowment portfolio. So in that way, they are sleeve
Okay.
funds. They're just exact carve outs of the endowment portfolio, which because that portfolio has been built out since 2006, that provides, a time to market advantage, particularly in private assets for others looking to get in, particularly in venture capital. And so, we're kind of a unique structure in that way, but we found success partnering with other firms and channels with those products in particular.
Okay. So let's talk about the OCIO market, maybe that side of the business first.
Of course.
What's a classic fully outsourced portfolio look like for you folks? And what parts of the governance do you take on? And where is it more up to the client to weigh in and make investment decisions?
Great question. That also highlights a little bit more about how we're different. We are fully discretionary. So even when outsource CIO clients on board with us, they outsource, that part of the relationship too. So we manage all capital on a discretionary basis. Our endowment portfolio forms the core of our OCIO clients' portfolios. It's our best ideas portfolio across asset classes. All our clients, are invested alongside each other according to the same terms alongside us at the firm too, as well as our board. So everyone is aligned in that way, and we manage the capital on behalf of all our clients, including our outsourced CIO clients. These clients, can leg into that portfolio as their core exposure in different ways, depending on, where they're starting from. So some of our OCIO clients, way back in the day now, maybe didn't have a previous provider. And so it was a relatively more streamlined transition. But typically today, these institutions have been with another type of provider for 5, 10, maybe more years now. And investment committees can turn over and needs and objectives can change. So, that's how we typically partner with new endowments and foundations, more recently going forward. With that, we take fiduciary oversight over all their assets. So including ones that don't, enter our vehicles, right away or even into the future. A lot of times these institutions have, what we call legacy private asset portfolios. And so
Sure.
those can't be liquidated right away or a lot of times anytime soon. So, we'll continue to manage and report on those even as, we transition more of their liquid assets into our endowment portfolio, as well as, our other vehicles when that makes sense. So we, write a full investment policy statement for our clients. Our endowment portfolio, the core holding, has its own investment policy statement as well, but our OCIO clients, require more customization around that. And so we tailor those specific to the clients. We also typically run a full liquidity portfolio, as we call it, or complementary liquidity pool to help supplement these clients' operational needs. But yes, we tailor the percentage of the endowment portfolio that's the core holding allocations to our other vehicles and how large the liquidity pool might be depending on the client.
Great. That's very unique, especially the part where you say it's not only your flagship, as you call it, endowment portfolio, but you yourselves and your clients, all of you invest in that portfolio or are open to investing in that portfolio. In the institute, in our institute, as you know, we're trying to establish standards and taxonomy and a vocabulary for the industry. In our vernacular, we would call you an investment specialist. Where
that
you
fits with us too. Yes,
yeah,
that makes sense.
because you're expressing a lot of conviction in your portfolio. Of course, clients are welcome to do other things, but that's interesting. So how many products does the firm have, and does all your client money go into these investment vehicles, or are you also managing, other than the legacy assets, a lot of separate accounts on behalf of clients?
That's a great question. We don't really manage separate accounts. We haven't in our history. That doesn't mean we never will, but we have always, as you just re-highlighted, have been, hyper focused on the maximum tight alignment we can have with our clients and with our investment process. And so with that, we even our vehicles that are outside of the endowment are still tied to the investment process that governs the endowment. And so our endowment portfolio is our flagship vehicle, $11 to $12 billion in that fund. And then our venture capital and buyout portfolios that comprise the endowment portfolio are offered as standalone funds as well. And then we do offer a direct public equities portfolio that we manage within the context of the endowment, specifically to our OCIO clients as part of that complementary liquidity portfolio we had mentioned before. It really as kind of a liquidity tool and hopefully a source of alpha in that liquidity pool. But we really have three core products, which is the endowment portfolio and then our venture and buyout sleeve funds. We have done other types of opportunistic vehicles for our clients throughout our history, just in terms of raising more traditional private drawdown funds, given the moment in time. We did a couple of those around the global financial crisis to try to capitalize on some of that dislocation. And actually, we've been doing a couple of those recently too. We raised an opportunistic private drawdown vehicle last year. This is also another tool primarily for our OCIO clients, although other clients are welcome to invest, just to kind of double down or have even higher conviction on some of the more direct deals that we're sourcing and want to pursue. We feel like this is a particular moment in time where we've been able to get preferred access to some nichier type of direct deals or co-investments or some kind of opportunities on the secondary markets that have been coming to play, and we're kind of using these vehicles to aggregate those to kind of maximize exposure to these opportunities for our clients.
It sounds like a great business model, and it must be also fairly clear to explain to clients, right?
Yes, we're simple and we like it that way. We try to, we know what works, at least for us, or in the context of Makena and what doesn't. And so, we're not right for everyone, but that's also okay. I think we want our clients to be aligned with what we're doing, just like we're aligned in all aspects of the business. So.
That's great. Now, speaking of clients, let's talk about your clients. You touched on it a little bit. Especially interested, In the international piece, you talked about, we haven't talked about that on the show, where you're seeing demand. And you also said something, in fact, in your bio, that you work with other financial services firms. I'm really curious as to, in what capacity do you do that? Do you compete with them? Do you collaborate with them? Maybe both. I'd love to get into that a little bit.
Yes, definitely. Other areas that can be unique to McKenna and have been very interesting for me personally, just through my own journey here. I've covered a lot of our client base in Asia in particular, as I've grown at McKenna. We have strong ties to the region, and we have since the firm's founding. We have large institutional investors and large families, particularly in Singapore, Hong Kong, and Taiwan. And so that's been great to see that area of the business grow. I think there's strong ties to the region, just given our Stanford heritage and also the draw of gaining access to, some of the top tier venture capital managers and opportunities from a firm who sits on Sand Hill Road, in the heart of Silicon Valley. So that's been great to see those partnerships grow over time. But we have a global client base even outside of Asia too. So some founding partners in Europe, particularly on the family office side, and then also in South America, South Africa, and also the Middle East. So we get around the world. We have for the past 20 years, but we learn a lot from our global clients as well.
Great. That's a really interesting business mix. So I want to talk about the family office because we haven't talked about that a lot before, because that overlaps with this sort of more traditional institutional OCIO, client base.
Yeah.
Have you noticed anything different about the family office business vis-a-vis, maybe what you were used to back in the NEPC with pension funds and traditional ENFs?
So, with family offices having evolved so much over, the past 10 or 15 years, just in terms of their size and sophistication and being more and more, institutional type investors in the market, there have been a lot more firms that have popped up to cater to that, and existing firms or existing platforms like some of the banks have evolved their offerings
Yeah.
as well. And so in a lot of respects, we've had more competitors come about over time, and we've seen that, and we've competed with more players or with other existing players that have evolved their businesses, when we are pursuing new OCIO opportunities. But it's also created more opportunity for a firm like us. And part of how we've evolved our product set, with the venture capital and buyout vehicles, has responded well in this new market environment in terms of us being a component of what these other OCIO type firms do and can offer for their families. So in a lot of ways, we've been helping each other because we can provide, unique, investment access and opportunities and in a compelling structure for their clients. And then we can partner with more families than we might not have been introduced to, like back in 2006 when the market landscape was different.
Great. Love to get into your investment process. I'm just curious, given a finite number of products, what is the life cycle of a product at your firm? You talked about these new products you're bringing on in addition to the legacy portfolios. What is the firm doing on a daily basis other than clients in terms of the investment portfolio? Are there always new, vehicles? You're always dealing with cash flows, new deals? And are they coming to you, or are you out seeking them actively?
Definitely. Great question. So all of our vehicles are perpetual or evergreen in nature. And so they're living, breathing organisms that the team constantly, manages. And so, that includes all of the cash flows that come along with that. And then also committing or investing in new opportunities going forward. And so, the team as I mentioned, they do all that on a discretionary basis on behalf of all of our clients. And so, when sourcing new opportunities, a lot of times they will come to us. I think the investment team sees hundreds of new opportunities in the form of new managers or new deals, every year. We don't do all of those deals. We kind of have a funnel that we use as part of our diligence process. A lot of it is inbound, but some of it, is outbound just kind of naturally through our network. So, we have deep ties to everything going on, where we sit out in Menlo Park. And so, dating back even pre Makena, to our Stanford days, we've had other investment team members who have led the venture capital and private equity portfolios at Harvard, at UVA, Northwestern. And so I think it's just keeping those networks very active and seeing how deal flow comes from there. Also with our client base provides that the two-way dialogue in terms of opportunities they're focused on and that we might want to try to get in on as well.
So I'm curious, maybe more like a pulse check given the times we live in. So do you find like the cash comes in and you have to sort of take some time to deploy it, or there's enough opportunities as you raise funds to put them to work? You mentioned your funds are all evergreen.
Yes. So when new capital comes in, they're immediately put to work in our portfolios. So, they just get immediately deployed according to the asset mix or asset allocation in our funds. And then we, commit to new managers or upsize with different managers or different investments, depending on, how, what the inflows levels are and how much more we can put to work across asset classes in the portfolio. That's all governed also by our, robust risk management practices and processes that really govern the endowment portfolio. And as part of that, we have, liquidity management and private asset budgeting that our team sets forth every year. And so the private asset classes, venture capital, buyout, real assets, they have budgets that they kind of fill or don't, depending on the opportunity set that kind of govern their investment activity on an annual basis. That can evolve as the year goes on. We do also, as part of that, have a more opportunistic, bucket in terms of our liquidity budgeting processes that can catch any, opportunities that are particularly compelling that maybe don't, squarely fit into a set asset class. But yes, we invest and deploy according to those processes. We also, as part of our endowment portfolio structure, have a annual distribution component or a dividend component consistent with how the large universities operate. And typically 80% of our client base elects to take that dividend. So we have that cash outlay going out every year, no matter what, really. And so that helps when inflows come in to kind of minimize or eliminate dilution, and then, helps us manage the investment process accordingly.
So the product set might be straightforward and finite, but nothing simple about managing the cash flow and operations, I would imagine.
Yes, it's very complicated behind the scenes, for sure. Yes.
Yeah. I want to zoom out a little bit. Obviously, you joined our Investment Solutions Institute, and thank you for your support.
Yes.
It's been great to have you. A very different firm.
Thank you.
I'm just curious, what made you join the Institute? Our mission, what we're trying to work on, and standards and transparency, but also building this community. Can you talk a little bit about, what you're trying to do and the client-facing or the industry-facing side of things? And then I'd love to get into benchmarking and evaluation as well.
Yes, definitely. We're very excited to be part of your community. So thank you so much again for welcoming us. And
Sure.
It was great to be with you in Boston in early April, even despite the hailstorm that happened, of course, as is typical in Boston at the start of spring. No, but I think, we're so excited just to connect with other firms who aren't like us. We are an OCIO provider, but are much different than the others, and we come across them more and more as the industry has evolved, and want to learn from what they're seeing and doing. So we're better informed about how we sit within that ecosystem. And I think just, as you mentioned, seeing if there might be ways to continue to work together with more of the larger firms in the industry. And I think it's just really helpful for us to hear about what, some of the larger firms are hearing from their clients, if it's similar or different, or how they've evolved their model to meet those client needs as those evolved. And then also just the benchmarking and other kind of industry perspectives on how to make evaluation more uniform. Firms like us don't necessarily help with making things more uniform because we are unique, but just in terms of being evaluated according to defined parameters can be helpful for everyone.
I'm going to guess that given the type of portfolio you manage, you get a little bit of a pass from the shackles of traditional index-based benchmarking, or do you not? And I'm just curious on what your take is on some of these industry standards and the CFA guidelines for composites and things like that. Is that something you're worrying about or thinking about, or really not in your lane at all?
It's a great question. We're very aware of them and look at them and know that we need to be informed about them, because even though we don't really think it's appropriate to benchmark us against those a lot of the time, that doesn't mean that institutions and potential clients won't do that anyway. So we have to be aware of that, and we always share how we benchmark ourselves. Of course, we don't get a free pass entirely, obviously.
Which is how, by the way, I'm curious, how do you benchmark yourselves?
So for the endowment portfolio, we have what we call our passive risk equivalent benchmark. So that is the global 70/30. So, from an investable alternative perspective,
you're talking about the world's market cap.
Yes,
in its entirety, equities, bonds, everything, the best you can measure it. Is that right?
Yeah. Yes, exactly. And that still isn't a perfect measure because, in our endowment portfolio, 40 to 45% of that portfolio is allocated to a liquid asset. So, that's not a complete apples to apples comparison, but we want to measure ourselves against what we view as the best passive alternative. We also use CPI plus 500 over longer term time periods to measure ourselves, given, the endowment style approach of investing in terms of protecting and compounding capital over the long term above inflation and above that payouts, that 5% dividend. We also tend to look at, Cambridge benchmarking and reporting. So from Cambridge Associates, that also isn't a perfect comparison, but they aggregate a lot of similar endowments and foundations to the ones we oversee from an OCIO capacity. So, we like to take a pulse on that. And then we also measure ourselves still against the top endowments. So, the Yales, Princetons, MITs, Stanfords of the world, we want to be, keeping up with them as well. So we have a lot of different measures for ourselves. It just so happens a lot of the industry OCIO benchmarks don't fit that as cleanly as some of these other ones.
Yeah, that's great. In a prior life, I was at benchmarking was one of my pet subjects, but I think it's great that you start with the 70/30 portfolio, right? I mean, the philosophy behind that is, listen, if you did nothing and you just invested in what the world has to offer, assuming you can access it, that's what you would do. So that's a logical starting point. And then the fact that you have all these additional benchmarks make a lot of sense. You mentioned some of these other firms. I want to go back to the question of how you work with them. It sounds like you partner with some of these large firms, as well as potentially compete with them. And especially when it relates to the financial advisor network, could you explain the relationship that you have with some of these partners and maybe their distribution network vis-a-vis their proprietary OCIO offerings?
Yes, definitely. That has been, one of the biggest, most rewarding ways we've kind of evolved over the past 5 to 7 years, I'd say. Our venture capital and buyout vehicles were launched as standalone vehicles in 2017. Again, the firm started with the endowment portfolio in 2006. And so it took a while for our private program to be built out. And then when it was, we saw a way to kind of carve out these asset classes where we had differentiated access and then a differentiated structure in terms of, partners who wanted to invest in those vehicles today could essentially bypass the private markets, build out the kind of dreaded J curve of investing in privates, and get immediate kind of active NAV in institutional venture capital portfolio. So when we were able to do that, we saw opportunities to partner with some of these, channel firms, as we call them, or banks, but they didn't see, offerings on their platform like we had in venture capital in particular. And so they wanted their family office clients to be able to invest in that portfolio. And so through that, we were able to launch and grow with some of these early sponsor teams and then meet new ones across the country from there. And so, I think in a lot of ways, we're going after the same clients, particularly in the family office set. But at the end of the day, we found we could help each other because we now don't have to, just offer our endowment portfolio to win those family office clients. We can partner with advisors to provide something they need and want. They think that's best for these clients, and then we all partner together at the end of the day.
Got it. Yeah, I think our world more and more we compete and collaborate. Yeah,
Yes,
so
we've seen
that's
that
great.
too.
Okay, great. Normally I ask about key differentiators, but I think we've already hit on quite a few. So maybe
Yes.
I'll just ask, is there anything you'd like to mention that we haven't covered that sort of you'd like the world to know about Makena or your business?
I think we've covered so much. I think, for us, it's just letting the world know that there are multiple ways to partner with us. And
Hmm.
even with the, proliferation of a lot of vehicles that might look like ours in the marketplace today, I think we still are unique in how our vehicles are comprised and structured. I think that particularly on the private asset class vehicle side, we've all seen maybe the headlines more recently than not about private evergreen vehicles and their pros and cons. And a lot of different types of firms have launched these products in response to the opportunity, with partnering with a lot of these banks and other platform channels. But I think our vehicles, their portfolios have really been around since 2006. They've been built out in the context of an endowment style portfolio, as if the team at Stanford was building it, which has really been the case, obviously, from our founding. And it's a way to kind of access that high quality, top tier, if you will, institutional portfolio for anyone immediately. And so
Yeah,
there's no time to market delay, and we provide full transparency into what
yeah,
investors are buying into, which can be unique as well.
yeah.
And so I think there's and we can always, continue to evolve and customize as much as we can for all
Yeah,
different types of clients' needs.
great. Now, I have to ask you because you're in Menlo Park,
Yes.
in the middle of the technology and AI revolution.
Yes.
I'm sure you have a lot of interesting ideas in your portfolio. But is there anything you'd like to share about what Makena is doing with AI or any prognostication on the future as it relates to our business?
Yeah, it's a great question. I know it's been a very exciting time in particular, at Makena and elsewhere out here. So, I think after a couple years of venture capital kind of laying low, if you will, to see over the past 12 months or week especially has been very exciting.
You've had some big pops, yeah.
Exactly. Yes. This is why you invest in venture capital. But you have to be patient, sometimes
Yeah.
extremely patient. But we've also internally at Makena have completely transformed how we operate and work with data from an AI perspective, trying to put our money where our mouth is. And we've
Yeah.
seen, great gains and efficiencies already. So we essentially redid our whole tech stack, if you will, in terms of building out our data lake through Databricks and then evolving from there in terms of other AI tools. We're very heavy users of both Claude and ChatGPT, as
Okay.
I'm sure everyone is now, obviously. But we've tried to be more on the forefront or cutting edge just
Yeah.
because we of where we sit, really. But we're
Yeah.
also using other kind of AI driven tools like Sigma, which is a business intelligence tool, another company that is kind of, allows you to do more, than Excel might be able
Yeah.
to allow you to do. And it's better integrated with that tech stack. So with Databricks and some of our other systems that we use, both from a investment data perspective and a client data perspective. So yes, so that's what we've been doing. But I think, as it relates to the industry, as you asked, I think is probably already affecting people and teams and how they're structured and operate. I think we've
Yeah.
been able to utilize a lot of our, AI driven efforts internally to help with outreach and account maintenance, especially with these partners we have. There's just such a high volume of advisors and clients and data around that, and gives you more opportunity of what you can do. But you also want to be able to leverage these tools to make you more efficient, as I mentioned. And we're still a small firm. We're just about 75 people, and we've been that way for a long time. And no plans to kind of double the workforce from here. And
Okay.
we're just trying to leverage technology to do more with our lean and mean team at Makena. So many of us who have been here for, 10 plus, 15 plus years. So
Yeah. That's great. You have such a great vantage point. Very interesting. And I've learned a lot. So that's very, very cool. Thanks for coming on the show.
of
And
course, no,
I
thank
wish
you.
you all the best. And thanks for being part of the Institute and joining our community and
Thank
sharing your
you.
insights today.
No, thank you. Really appreciate it. It's been such a wonderful community and partnership so far. So thank you for this opportunity and look forward to many more together. So thanks so much, Robbie.
Great. Bye. Thank you.
Hi, thanks.
Chestnut Advisory Group is a boutique, practitioner-led management consulting firm dedicated to asset managers and investment solutions providers. In addition to the Chestnut Solutions Institute, our advisory practice areas include distribution strategy, M&A support, go-to-market, and implementation and coaching services. This podcast is owned and produced by the Chestnut Solutions Institute. If you like this content and would like to access more insights, webinars, and podcasts, please check out our website, chestnutadvisory.com.